Thanks for joining in. Today is going to be a little bit of a different celestial webcast. Let me just pull up and thanks for all of you folks understanding that I needed to postpone yesterday's to today, and sorry for any inconvenience that I might have caused everyone. We'll be back on schedule 2 weeks from this past Wednesday, which is going to be September the 21st, and at 3 o'clock. Now, and this is the schedule right here, so you pretty much can stick to it. And so again, Wednesday, September 21st, and we'll be dealing with a new moon at perigee that will be occurring on September 27th. Now, really, the next lunar aspect that we have, this is going to be it's a very quiet time period. It may not be so quiet in the markets. Actually, as we're doing this right now, a little bit of pressure on the Dow, down 101 points. S&Ps are down 12, and the composites down 19. When we take a look at astro-wise and moon phase-wise with regard to what's going on out there, up on the top as far as the daily aspectarian, today, September 8th, there is a Mercury-Neptune major aspect. But I went through the charts just as I've done for you for the last several webcasts for anything that's been going on, during the week or maybe a couple days after. And in fact, each of these aspects that are on here, the major ones, the Mercury opposite Neptune, Mercury trine Pluto, Venus, and Mars, and I've gone back through, pretty much back to 1929 just to see if there was anything that had a significant turn, whether it be short-term or what have you. And quite frankly, there was nothing that was probability-wise that was to our advantage when I took a look at those specific aspects. And so what I didn't want to do was really waste your time there. This whole process is first to understand celestial-wise what aspects might be having an impact on any of the markets, whether it's the stock markets or currency markets or futures and commodity markets. Thank you. I just had to get that out of my mind there. And really, when I took a look at these aspects here, there was nothing significant. And so what I want to be able to do is we're really taking, we're in a real important time period here from the standpoint of going, in my opinion, for going short. And so what I wanted to also do from an educational standpoint is really focus in on really two things. One is the Gartley buy and the Gartley sell pattern. Also, with regard to the calculator, I'm going to show you the calculator. I'm not going to be able to get it up to you on your site just yet. Ran into a technical problem, but it should be there early part of next week, but we're going to go through it here. And also, this is going to be a little bit more interactive after we go through the Gartley piece of it. So I'll take questions. Maybe there's a chart that you're looking at. Maybe you're doing some charting, and you might want to want me to take a look at something with regard to perhaps a Gartley pattern, and I can do that. So, we'll save that towards the end. We'll see how much time we have left here. We'll probably run this to about 3:50. It's 3:06 right now, so we've got a decent amount of time. And we'd also take a look at the moon phases here. The only real significant moon phase. Now, you can see here in the September 8th, today, Thursday, I've got the moon void, of course, which you have happen, fairly often. That's just really the moon moving from its last aspect to the next zodiac sign. And typically, there's a period of time there when the moon is void, of course, where there's a little bit of instability in the markets. Of course, we've just kind of had major swings, for so long here, for the last several weeks, that, I don't think that the moon void, of course, right now is something that it typically has more of an impact on the gold or silver market than it does on the stock markets. But the real next big aspect for us is going to be Monday when we're coming into the full moon. And I'll do a full-blown video newsletter as I normally do. We'll take a look at how we might consider playing that. And, we're going to see whether or not really where that's going to be a high or low. And right now there's just simply no way to know, but we'll go back and we'll take a look at the charts. We'll take a look at the patterns that are currently out there. So, again, today, from a celestial charting standpoint, there was nothing new that I could really add, and your time is so valuable that I thought, why don't I teach you something that we're looking at and something that's really going to be a part of the charts that you'll be seeing here as we take a look, as we come into this next sell point. So it's really all about this guy right here, H.M. Gartley, Harold M. Gartley. That was the only photo that I was able to find of the young chap. And in 1935 is when H.M. Gartley published the book Profits in the Stock Market. Now, it was really during the Great Depression, very, very tough times. And the price of that book, and it may be tough to correlate. And so what I've done here, the price of the book was $1,500 back then. And he sold 1,000 copies. So just to try to put that into correlation, what else could you have bought back in 1935? Well, the cost of a new Ford automobile was $500. So, I want to picture, and it's just because Ford, there weren't many automobiles made back then. So I want you to picture your car right now. And if somebody was publishing a book, right now, hey, we're in some tough economic times. We're not in the deepest part of our potential depression that we have. But when you think about the price of your car, and I haven't priced this out in gold or anything like that, but, would you plunk down what would be the average cost of a car, maybe 25 grand, something like that? Would you spend 75 grand for a book, Profits in the Stock Market? That's really kind of how important his work is, and what 1,000 people did back then, and it is why really it's so important. But what we have the benefit of is we have the benefit of great technicians who really studied H.M. Gartley's information in the book. And the interesting thing is, there's really just a couple of pages that when you take a look at what you were getting for the $1,500, not that there's not a lot of information in the book, but the focus really comes down to page 222 in H.M. Gartley's book. And this is a copy of basically of page 222. And what we're going to really focus on here is we're going to really focus on this pattern right up in here, if you will. And you'll see that. And that's where we're going to be taking a look at either the Gartley buy or the Gartley sell pattern. In this case here, where we're taking a look at this figure in here, we're looking at the Gartley sell pattern. And the Gartley sell pattern, what you're basically doing is you're taking a look at this trend, this move down here. And a Gartley pattern is an A to B equals C to D pattern that gives you another entry point to continue going in the direction of the move. And what it really looks like, folks, is it really looks like either of these two. So when we refer to a bearish Gartley, since that's what we were just talking about, so that's the chart here on the right-hand side, the X point is going to mark basically the top of a swing point. And so you're going to have the top of a swing point and you're going to have a move down, so the X to A. Now, in this Sunday's charting newsletter that I did, what I incorporated, not only did I incorporate my Ensign charts, but I used David White's art of the chart, new package that he's working on. And so I will incorporate those charts when possible, because one of the beautiful things about that package is David has a unique way to be able to measure the power of the move of, in this case here, where this would act as a swing point all the way down to really what becomes the next swing point. And so we'll be able to measure this, and this is especially helpful from a volume standpoint in the stock market. So when you took a look at those charts, if you reprint out Sunday's newsletters, you would have seen, a delta figure there. Maybe it would say 24 in like a V or something. And maybe I can pull one up a little bit later. But, go back to Sunday's chart and you'll see a volume characteristic down there. And so what's nice about that is if you've got a strong volume down, it's really going to make the Gartley pattern even all that more important for us to understand. So a Gartley pattern is really a retracement back to this move here, and the retracement point in this case here is going to end at a D point. Normally, if you just simply traded ABCs and you just simply either bought on the D or sold on the D, you would have a pretty good system. In this case here, what we're doing is we're buying or selling on the D. In this case here in the bearish Gartley, we're selling on the D, but we're also going ahead and we are taking a look at geometry, or we're taking a look at sacred geometry, if you will, or we're taking a look at Fibonacci numbers. Now, H.M. Gartley did not use Fibonacci numbers, okay? So if you go back through his book, what H.M. Gartley used in this case here was simply an ABCD pattern to complete the move. And much like what we can take a look at when the market moved down last week, and we'll go back and we'll take a look at that, we did complete an A to B equals C to D pattern, a 1-to-1, or very close to it, but we didn't get close to the 0.618. We didn't get close to the pattern that I had drawn out in the newsletter. So, and the reason why we've incorporated the 618 retracements or the 786 retracements is simply because it gives you a better reward to risk with regard to where it is that you're going to place the stops. But there are times when, you may just simply want to go ahead, or we may just simply want to go ahead and sell on the D point if there is some other sacred geometry number, maybe an expansion between two swing points, like from the B to the D area, and that might make sense even with a wide enough stop. And that's where the probability calculator that I've created for you is going to be very helpful. So this is what a bearish Gartley pattern looks like. Whoops, I probably shouldn't have done that. Let me put this back on the screen here. And this is what the bullish Gartley looks like. So where you have a move up and you think you've missed the move up, and what you wait for is you wait for an A to B equals C to D to move down. And when that is completed, hopefully what you're looking at is a 0.786, a 0.618 retracement, and that's when that gives you the opportunity to go ahead and fire away and get into the trade. Now, if you also important out of H.M. Gartley's book is this page right here. So this is a page where, on graph paper, he was keeping track of exactly the high to the low of each of the weeks by month here. So you can see this is from 1929. Now this is not his writing on this sheet of paper. This is a sheet of paper that was copied and then some additional notations that were put on there. So he didn't mark October 1929. He didn't mark the November low. He didn't put the A, B, C, D. But that was done, in essence on his page 222 in his book. But this is a page taken right from his area. When you see the word perfect, and I touched on this morning in my radio shows, I want you to use the word perfect with a real grain of salt here, because we've got tools that are real exacting right now. So when we want to know what the 618 retracement is from between two swing points, it'll give you the exact number to the T. So we're just simply looking for a range, and that's really what the probability calculator is also going to help us with. So this is a page from his book. You can, take a look at it. What I've done, simply because of the tools that we have at our disposal, is I've gone ahead and I've put down, exactly what 1929 looked like. So historically, when I go back through my chart, and this here is the daily chart, this was the low that we were referring to in the previous page, right back in here. So the November low, as you can see, and this A to B that equals C to D is the equivalent of this move right here. So now what you can also see, and what I do talk about, is I talk about the importance of the power of the C to D move. You really want to pay attention to the C to D move. The tool that I use, and hopefully the tool that you use in any of the software charting that you have, the tool that I'm using, it maintains the exact same angle from A to B as it does from C to D. The distance that you move out is just simply, your retracement area. So in this case here, and this is something to really learn from with regard to whether this is going to make a retracement back to the 0.618 area or whether it's going to make a retracement back to the 0.786, is really going to be what is the power inside this move. In this case here, where you see the retracement going to the right of this move, it's telling you you've got a weaker move from a time standpoint. Now, in this case here, you saw back on this book, the notation was, a perfect A to B equals C to D. Well, the reality was it all depends on what you define as perfect. In this case here, perfect, if you were going by the numbers, perfect would have been 312.67. As you can see, what it did is it completed an ABCD. In fact, just a little bit underneath that, which would have been at the $298 level. Now, the other reason why I really wanted to show you, my page versus this is because you really don't know what happened after this. Most folks are thinking, you had the crash of 1929, and that's what it was. Well, the reality was, yes, you had the crash of 1929, but that wasn't the low, folks. You can see that once you broke through here, we came all the way down into this, $40 area on the Dow. So it went on through 1932. So this was going into a bear market. We are in a bear market right now. And so in Gartley's case, when he talks about simply selling the first Gartley pattern inside the new leg or the first leg of a bear market, and we showed you some examples of that in the past. I think I'm going to go through that also here on my charts. This is because we understand the possible outcome that's here, the probable outcome that is here. If we go take a look at right now, this is the Dow Industrial from October of 2007. And what you'll see here is really you're going to see two different patterns that I've got. You're first going to see this is a butterfly pattern. This was the August 17th, 2007 date right here, this candle, which was really an important candle because as soon as we took out those lows, that indicated that we were going into a bear market. And the reason why was because the astro aspects during those 7 days, during that time period, had never been broken in hundreds of years. Now, I covered that in the webcast that we did a couple of weeks ago. So if you're a new subscriber to listening in, you have all of the archived webcasts. I realize that they're about 50 minutes or so, but there's a lot of important information or archived information, and it's worthwhile to go back and take a look at that and listen to this. I hope that this webcast that we do is going to be really important for those of you that want to understand the Gartley techniques because, you know, my real outcome and objective here is really to be able to empower you to be able to look for these trading patterns and provide you with the tools so that you can trade on your own as well. And so that's really what the outcome is. And then maybe you can teach someone, and hopefully it's a family member or a friend, someone that's important to you, and then they can teach someone because, you know, I really believe that the new industry that we have out here is the industry of money management, and the more people that we can get involved with understanding that, the better off things will be, especially when you go into markets. We don't really look. We would like a market to continue to go up and for there to be positive, a total positive environment. But it's just simply not the way the world works. And so you need to be able to learn to be able to make money going both ways on the markets. At least that's what the real money managers do. And so I know that's why you're here. So in this case here, once we broke these lows, if you were familiar with H.M. Gartley's work, what you would have known right then and there was you were going to go ahead and sell the first Gartley pattern. Now, you can see here the first Gartley pattern was a little bit more than a 0.618 of this area here. It was probably a little bit less than a 0.618 going back to this swing point. You did have an A to B equals C to D. It quite frankly got above the August 17th area, and this was the area to go short. The results of that, you know, we all know what the results of that. This is where the Dow here, when it completed this pattern, was in 13,180 area, and we know that the Dow finished down in the 6,000 area, 6,000 to 7,000 area. So we know what the results were, where you took a 50% haircut from this point here. So it's why we're really in a real critical time. If we go ahead and I pull up the New York, the NYA. And the NYA is really, the New York Stock Exchange is the one that I really want you to pay attention to because you've got 5,000 stocks basically that are inside this. So you've got all the stocks versus 30 stocks in the Dow versus 500 stocks in the S&P. So it really will be the NYSE that will be paying attention to, and you'll notice on my charts you'll be able to see it will say NYA. Sometimes I label them down here, sometimes I don't. And so just pay attention if you see NYA. It's talking about the New York Stock Exchange. Here we can see what we've done, what we did back in the 2007 timeframe. Again, here was the August area that got busted, and once that got busted, folks, what you wanted to do was you wanted to sell the first Gartley sell pattern, and you can see here it was a 0.786. In this case here, what was nice is you actually made a butterfly. This is a butterfly pattern, and maybe during the next webcast or at some other webcast, we'll go ahead and we'll take a look at butterfly patterns. A butterfly pattern is really what formed in March of 2009, and so when we do take a look at the butterflies, we'll go back there and take a look. And typically when you have a butterfly pattern, folks, I will tell you that the type of retracement that you will make is you will typically make a 1.272 expansion from this swing point up here, okay, where you start this A to this D point, and so which means you would be up higher, or the 0.618 of the total move down. The interesting thing is the reality is that from the highs of the stock market to the low of March, that's actually what we did. So, but we'll come back to the butterfly pattern. But here is the Gartley pattern. Here's why you want to be paying attention. We want to be paying attention to, and what I really would like is I'd really like to see the completion of this pattern here sometime soon. This is the NYSE right now. This was as of last night. I didn't update that for today, but the AB equals CD, okay, the larger pattern that's out here, the ABCD completes right here. a 0.707 area would complete right here. So this is really what I've set up as our preferred target range should we get the market to bounce up. And, this here, when you see these two lines here, this is the 50-day, the blue is the 50-day, the red is the 200-day. I don't use the moving averages too much, but this is referred to as the death cross. And I know I addressed that in one of my newsletters. And so this is the this is right now the target area. And so as we get into this area, should we get into this area, and I think we will have a chance, should we get into this area, this is where we're going to be looking at shorting. We may, in order to short the marketplace when we get up there, we may get stopped out a couple of times along the way because the market could always bounce higher. But if it takes us 4 or 5 times, even if it takes us that long to get a short entry, this is that's okay. This is going to be, you can see how markets move down. In this case here, when markets move down, and this is really our A to B point, if you will. Our A point is up here, our B point is down here, and this becomes, in essence, the new C point. So you can see we've got a huge move. Chances are, when we do break through these lows, what we're going to see is much more than a 1-to-1 A to B equals CD down. I've gone ahead and I've included this page here. This is a page from one of Larry's books, one of my favorite books. It's called Fibonacci Ratios with Pattern Recognition. I've got that down here. I absolutely suggest that you go out and you buy that. It's like a workbook, and it is a great workbook. It's got a lot of great patterns in there, the reason why I have this book here is because what we know about Gartley patterns is that when they fail, they typically turn into a butterfly pattern. If I go back here, there probably was a I don't see a Gartley pattern right here. Let me just say this much right here. If this 786 had failed here, this likely would have turned into a butterfly pattern, and you would have been well above 10,400. And the 786 area is kind of like our last bastion, if you will. It's really the problem with a 618 Gartley is the fact that there is a chance that you're going to go to that 786. And so the question always is do you get in at the 618? Well, using the proper 1% risk standpoint, the answer is yes, you do, unless you see something else going inside the pattern along the A, B, C, D. So remember, in this case here, where if we had seen a move up and the C to D was well within inside this leg, telling us that it was strong, then in that case we would have said, okay, let's go ahead and wait to the 0.786. But if your C to D move doesn't have a long-range bar, doesn't have a gap up inside there as you're completing the pattern, then what that's telling us is it would be time to go ahead and short it at the 0.618 level. But what will happen is if that 618 fails, which it can do, then likely your next area is going to be the 786. So you're always going to want to take a look at putting your stop when you take a 618 Gartley sell or Gartley buy pattern. You're going to look at wanting to have your stop on the other side of the 0.786. That's why what I really teach is first figure out the risk and just simply take 1% of your trading capital and then divide that by what your stop is. So you've got this page here, and the important part of the Gartley pattern is taking a look at any gaps near the completion, and near the completion we're talking the D point and any wide range bars. So you've got this to go back to. Most important thing here, folks, is going back to Fibonacci ratios, pattern recognition. I think it's maybe about a $20, $25 investment, one of the best investments that you absolutely could make. If we take a look at so that's what I have right there on the Gartley patterns. Let's see. So we've got 327. What I want to do right now is I'm going to pull up the calculator so that you can see this is coming traction of what you guys are going to have access to. This will likely end up being a paid subscription service, but for all of you subscribers, it's free. It'll be included with your service, and it'll be a tool that you'll be able to use for any of the trades that I send out. As you know, right now when I send out a trade, and you're kind of familiar with this top portion here, you saw it really in Sunday's newsletter. Or Monday's news, I guess I'm saying Sunday, just thinking of the weekend. And so let me show you the way that this works. So let's say you can pick any symbol that you want, and let's say that right now, for example, that we wanted to just go ahead and trade Apple. So you would just simply type in the actual symbol, and then you would go ahead and you would hit the find button. And what this is going to do, it's going to go out, and it's going out to a database, and what it's doing is it's taking its time right now. And what it's doing, it's going out and finding the symbol. Well, it's really doing two things. Number one is finding the symbol so that you can confirm what you've typed in here, that it's pulled up the data. Now, data, you're familiar with the fact that I have been using the average weekly true range. So I've taught you about using the average weekly true range, and I've used that because it's an easy thing to manually calculate. Well, now that we have gotten all of this live data that we have being fed in here, I'm actually using the true daily true range. So that is one change that you will see in this part of the system from what it is that I've taught you. This actually is more specific, and the important thing about the true range, folks, what I want you to understand about that is that when you enter a trade, none of us really know, even though we can use these sacred geometry numbers, we never know if that's exactly where the low will be or the high, depending on which way it is that you're trading. And so when you've done all the work, when you found a Gartley pattern, a butterfly pattern, a test of a swing point, whatever it is that you trade, whatever the system, a Chapman wave pattern, whatever it is, what I want you to be able to do is I don't want you to get knocked out of the trade that day. And so what we like to do is we like to go take a look at what has been the average true range, meaning the high to the low, and so that your stop is at least outside of that on a daily basis, because there's no reason to do all this work and to put your risk up there only to have missed it because of the daily noise. And when I use the word average true range, it's really the noise inside the marketplace from a day-to-day basis. Now, when we typed in this symbol, what it also did, folks, is also went back and it took a look at the last 2 weeks. Now, because we have a holiday, in this case here, and because I didn't want to change the programming, it would have just been too much. What this is doing here is this has gone back and this is telling us exactly by day what the true range was. So in the case of Apple, yesterday the true range on Apple was $10.45. The day before that, it was $13. The day before, or the trading session, I should say, before that, on August 29th, was actually $7.70. GU stands for gap up. So we have accounted for any gaps inside the stock so that we're not just taking a look at the high to the low of the individual day. If, for example, today it closes at $300 and tomorrow it opens up at $320, we've accounted for that $20 difference, if you will. So in this case here, we know that Apple, how about that? We know that Apple gapped up. We also know that in this day here, which would be September the 2nd, that Apple gapped down. So these are your daily true ranges, if you will. And what we've done is we've gone back and we've simply divided that, in this case here, by 9 trading days. Normally you'll see 10 trading days in here, and you know that that's what your true range is. Now, what I have typically been using for the weekly true range has been 2.7. I'm going to go ahead and leave that in there for the time being, but many times, and 2.7, what that really means, folks, when you've gotten into the trade here, is that you're saying that I've done all my work, and I'm going to go ahead and give it a stop that is going to be 2.5 or 2.7 times, what on average takes place. That should be a wide enough area, especially if you're looking for a longer term trade. And I use it for any trade because, I've done my work, the pattern is here, and I don't want to just get stopped out because I was too tight on the stop. This is all about trying to make money. Now, what I do know is if, in fact, the trade goes against me by over 2.7 times, I was wrong. My analysis was wrong, or, it just simply was wrong, and you should be taken out at that stage. So that's when you type in the symbol and you hit find, that's what it's going to do. When you hit this info button, I'm not going to do that right now, we're generating some information, additional information about the company, maybe if they pay a dividend, when their ex-dividend date is, what they've been paying out, maybe what their earnings before income and depreciation, amortization, just some additional, what the short interest is. So there will be short interest automatically. Now, this information is being pulled from Yahoo Finance, so at this stage, you always still want to go back and do your homework, but I'm pulling it right from their website, and it's pretty reliable. Now, what you're going to do here is you're going to want to select an instrument type. So in this case here, we know that Apple is a stock. We're going to go ahead and select a stock. The question is going to be, are you going to be going long or short? In this case here, let's just say that we're going long for our example. Now what you're going to do is you're going to put in your trading capital. So in this case here, where I've been providing trades to you and I've been trying to give you a position size based on a 10,000 share lot once you've got this in your hand, I won't really need to do that anymore because you'll have this tool available to you. And maybe I'll still do it for each 10,000 shares, but you'll have this tool available to you so that you'll be able to come in here and you'll be able to put in your trading capital. And let's say your trading capital is $50,000. You can put in a 50 and a comma if you want, or you can just put in $50,000. It won't matter. And then the question is, what is the percentage of the risk that you want to take? Right now, one would be 1%. If you wanted to take a 0.5%, you would just simply put in 0.5. We already have, this is already calculated, so you don't need to adjust this. Now the question is, well, what's your entry price? Now, I'm just going to come down here. I see that, yesterday it closed at $373. I'll just simply go ahead and put in here $370, and let's just assume that Apple's going to the moon, and we want to ride along with it, and the moon happens to be a $500 exit point. At this stage, then what you're going to do, you're just simply going to hit calculate, and it's going to give you your trade information. Your trade information right here, you'll be able to print this out. You'll be able to go to your web browser, print this out, or come back and adjust it. But it's going to tell you your entry price was $370, your hard stop $346. Here's what your per share stop was, $23, 0.5% risk. What your position size is, 10 shares in this case. What your exit price is, what your reward to risk is, 5.2. How much per share you're going to potentially earn, and how much of your trading portfolio. If I come back here, and I put in a $1 for a 1% risk, and I come back here and I hit my calculate button. What you're also going to see as soon as this is done, we'll give it a second here. I've got a number of things running on my computer right now, so that is part of. Now, what you're going to see is you're going to see something pop up that says your total portfolio percentage allocation is too high. In this case here, my recommendation is that you wouldn't put more than 10% of your total trading funds that you have in any one stock. And that's what this message is. That's why this is coming back as 15%. You're welcome to if you want, but what I'm suggesting, and that's why when you want to come down here and you're selecting a stock, I'm going to have a different percentage that will pop up. It will be 10% for a stock. It'll be a different percentage for an index ETF, and it'll be something different for a sub-index. A sub-index maybe like the XLF, XLK, something like that versus the SPYs or what have you. And so that is how that works. Now, what you can also do, let's say you're a subscriber to some other newsletter, or you have some other stop method that you want, and you just want to understand what your position size is. So in this case here, let's say that maybe you subscribe to Basil's newsletter, and maybe he says take 25%, a quarter position in something, and he gives you what the stop is. Well, let's just say he gives you a stop of 2.5, $2.50. So you could just come back here. You could change your average true range to 250. You can change this factor here, your stop multiplication factor, to 1, because we know 1 times 250 is $2.50. You can go ahead and hit the calculate button. Again, our total portfolio is too high because now it would require us to get 37%, but this will give you what your position size should be based on that information. In this case here, with it being 37%, you could come back down here and you could change this quite a bit. So that is how the position size. Now, you could also come back in here, and if you were going to be shorting the stock and you were going to short the stock, then obviously what you'd be looking to do is you'd probably be looking to go ahead. Your entry price is where you would, in essence, be selling. Here's where you would be buying it back. So maybe we'll play around with the heading right here, but you'll know right now what it's for. So let's say you're going to sell it short and you're going to buy it back for $250, and you had a $2.50 stop. You would hit the calculate. So this is giving you a lot of great information. Here, both from the short side here, you're going to enter. Here's where your stop is, which is above it, and here's where you're going to, in essence, you're going to exit, you're going to buy, and you're going to close your position. And so that's this tool here, and I think it will be a real help to you in your trading, in anything that you come up with, and in helping you be able to come up with a proper position size. So it's 3:37. And let me go ahead and open it up to any questions that you might have. If you want to go ahead and type those into the screen there, if you've got any. And after I'm able to release the position size calculator to you, then what I'd like you to do is go through it and critique it, come back, maybe some way to improve it, make it better for you. Just any thoughts that you might have over the course of the first week or two that you've got, and I'll see if there's some way to to modify to incorporate any of the suggestions that you guys might have. So let me open up the floor to any questions right now, or we can go to some other charts. So let's see, and I think we're live, so that you can type in here. I don't see anything just yet. Maybe I've put everybody to sleep. I hope not. Let's see. So no questions. All right. Well, let me just go ahead. Maybe there are some questions and someone is typing. Let's just go ahead and take a look at the markets. Right now we've kind of been up and down. Right now we're down 91. So let me go ahead and pull up the charts here. But if you've got some questions, go ahead and go ahead and post them. And let me just type a message into my production guy. Make sure that you guys are able to type in. Give me 1 second here, folks. Okay, so let's take what I first got up here on the screen. One of the trades that we came up with was CSX, and we did get into CSX 2 days ago. And what I was looking at there is I was looking at the support and resistance, this high volume bar that we had here. We had come down and we had tested on August 24th with 14 million shares, and then we came down on Tuesday and we tested that with 9.4 million shares and closed above that low. So really a nice entry point on this trade here. Let's see, there is a question, says Steve, what database is the info being pulled from? The info is being pulled from a Yahoo database. Yahoo Finance is where that information is being pulled from with regard to the true range information. So if we're taking a look here, we had a nice day yesterday. We came up on 10 million shares. We're coming into this bar right here, this downdraft bar that had 7.8 million shares today, right now, and we've only got another 20 minutes in trading. Pulling back with almost a similar volume to what we had yesterday. If we were to take a look at the 10-minute chart, what we basically did on the 10-minute chart on CSX. Let me pull that open here. What we really did was we came back and we filled this gap. Even if you take a look at this swing point right here, you had 637,000 shares. And when we came and we tested that with 400, 252, 241. We tested it with 280. So you can see that this actually is really looking like, now this is a longer-term trade that we're looking at when we're taking a look at CSX. So, in this case here this week, for example, I provided, I think it was 11 trades, and obviously I mentioned yesterday in the newsletter that I sent out that on the front page of the newsletter will be a current list of any trades that we have that are open, or any trades that are still on our buy list, and I will, as I take any trade off of our buy list, we'll also have that on the first or the second page as well, and hopefully that new format. Now, many times, folks, I am looking at the charts early in the morning, taking a look at the international markets, taking a look at our markets, and I'm putting because I am providing, or I've been excuse me here, let me pull this back up. For example, in this week's newsletter, I was taking this information up here and just pasting that in, and maybe I had an entry price of, say $115, and the stock opens up below that. If I've got a price of buy at 115 and opens up at 114.75, as long as it doesn't open up below the stop, it is a good entry price. And unless I see something else, and I'll go ahead and send something out to you. So it's always going to be at that price or better. It's really impossible for me to identify exactly where a market is going to go up. In many of the cases, I'm always really paying attention to what's going on in the futures market. Are we coming up against some type of support or resistance? Hopefully we are before we're either going long or short before the market opens. Doesn't mean that those areas will hold, but it gives you a whole lot of information and a little bit more confidence to go ahead and take the trade. And Tuesday really was ideal because we were right up against a support area. We had our markets open up at a 0.618 or 786 retracement, and that really gave us a good trade. If we go ahead and pull the charts back up here, Steve, could you use your calculator on TNA for me? Yes, I can. So let's come in here and we'll type in TNA, and I'll go ahead and I'll hit find. Now, when I hit find, it's not clearing out. I don't believe it's clearing out these fields. Give me a second here. See if we've got that piece of it completed. Let's give this a second. Okay, so you're gonna you'll in order to use this, you're gonna have to come back up here unless I get this fixed before we go live, where it will just clear out the instrument type and whether we go long or short. And I don't know whether to go ahead and clear this out or whether you'll be taking a look at just stocks, and so you want to leave it in there so you don't have to fill that in. I'm leaving the capital balance in there. I'm leaving the percentage risk in there. But these are fields that could easily just be cleared out each time you hit find, or I could leave those in there, initially while you're using the tool. But in the case of TNA, if you're looking for what the average true range is in it, the average true range would be $4.86 over the last 9 days. And this would take into consideration the gaps up and the gaps down. So I don't know if does that help you, Les and KJ, as far as what you were looking for? Yes, long, yes, okay. No, I realize that it is long. What I'm saying is that when you go ahead, let's say you've done, in this case here we did Apple first, and you had TNA, and you put find. In the case of TNA, it's really not a stock. You would come down here, and it's really a index ETF, since the TNA is really a mirror of the Russell 2000, just the 3 times short. And then you would want to come down here, and you'd want to input long, and depending on what your trading capital might be, then you'd be taking a look at, if you're going to try to enter that thing now, you'd be looking at, well, it closed at $39. Maybe you were going to enter at $39.50, and maybe your price projection was $48.75. Just to see if you had a good trade, you'd hit calculate. And then what this would do is this would tell you your information, and it would give you the idea of what your reward to risk is. Now, what you're also going to want to do is, I apologize. In this case here, we left that at 1. So the question is going to be whether we're using 1.75, we're going to be using 2.75 or 2.7. I know on the weekly true range calculation that 2.7 works good, always has. There will be other pieces of information I'd like to be able to add to this, such as swing points, so that we can see how far away our stop is from a swing point. But this will be a good first start for you in order to be able to trade, in order to be able to take a look at your reward to risk. In this case here, this may not be a good trade because it only – well, actually, I'm sorry, it would be a good trade. You'd have a 4.6% to 4.6%. In this case here, 0.25% only is risking 1. The power of 1, folks, it's so important to use that power of 1 and only risk 1% of your working capital. But you also really want to pay attention to this portfolio allocation percentage. You don't want to go all in because that could be, we can't control the markets and what's going to happen. So. Let's see, we're at 3:46, so really about 3 more minutes before we would stop. Any other questions that you might have out there? If we go take a look at the other trade that is active right now, which is the SPYs, if we take a look at the SPYs and see where we're at, we really have a draw, if you will, in our tug-of-war game. Looks like we're going to have a little doji candle. We've got volume of 220 million so far, more volume than we had yesterday. If I have a concern, it's that what we've done today is we closed the gap. We're coming into this. Now, the swing point is right up here. So I would have been a little bit more concerned if we had gotten into the swing point as well as closed the gap. We haven't done that. Where we have gotten to, though, and always a reason to be cautious here. As you can see, we've gotten to the 0.618 retracement, but we did that yesterday on a wide range bar. The bar, when I take a look at it, is really including this gap and is from here up. So I do think right now, until something changes, that it looks like what we're really going to have the opportunity is for this. And again, I pulled up the NYSE for our area to short. But, we're going to, I will change my opinion as soon as the market gives us more information. Today, the market has not given me any information to change my opinion at the moment with regard to the trades that we're in. I'll spend tonight doing some scans, looking for any bearish candles that might be out there, and that's it. So I hope that today has been helpful for you, educational for you. I hope that you go back, because from an archive standpoint, that this, learning the Gartley patterns Gartley buy and Gartley sell patterns. They work on all time frames. Just whatever you're trading, stay inside the time frame. And typically, when a Gartley pattern works, it's going to retrace to the A to D point. It's going to retrace back to the 0.618 area. And when it gets to that 0.618 area is where you're going to have to take a look at volume to determine whether or not you're going to stay in the trade for a longer period of time. But we can cover that later. So hopefully this has been great. Thanks so much for joining me here. As always, any questions, reach out to me, whether it's by phone or whether by email, steve@tfnn.com. You folks have a great Thursday. It's Sushi Sake Thursday, folks. So go have hopefully you have a great evening, and I look forward to talking to you tomorrow morning. Take care. Bye-bye now.